If you run a small or mid-sized business and you're thinking about raising money, buying a competitor, or even selling your company, you probably heard three labels tossed around like they're interchangeable: family office, private equity, and venture capital. They're not interchangeable. And picking the wrong one can cost you time, control, and a lot of momentum.
And sometimes you don't realize it until you're already deep in meetings, sending financials, answering the same questions 5 different ways, and wondering, wait, are these people actually going to do a deal? Or are they just learning my business?
Exactly. So today we're doing a practical guide for SMB owners and operators. Family offices versus private equity versus venture capital. We'll talk pros, cons, what the process really feels like, and how to figure out which path fits your goals, whether that's growth capital, a partial sale, a full exit, or funding and acquisition.
Let's start with a quick reality check. Capital isn't one thing. You're not just choosing money, you're choosing a partner, a timeline, and usually a new set of expectations.
So let's set the table. We'll define each group in plain English, then walk through how they evaluate deals, what they care about, and what it's like to work with them after the check clears.
Okay. Family office first. A family office is basically an investment organization that manages the wealth of a high-net-worth family or a small group of families. Some are very professional, staffed with former bankers and investors. Others are leaner and more relationship-driven.
And the key point, it's the family's money. That changes incentives. Often they can be more patient. They might not have a strict fund life, and they may have flexibility around deal structure.
Private equity is different. Private equity firms typically raise a fund from limited partners, pensions, endowments, institutions, high-net-worth investors. That fund has a time horizon. They invest, they grow or optimize, and they aim to exit within a fairly defined window.
Venture capital is usually looking for high-growth companies with big upside, often tech-enabled, scalable models. For an SMB audience, VC is relevant if you have a product that can scale fast, a software component, a platform play, or something that can become very large. A steady, profitable local service business usually isn't a VC fit.
So here's the first filter question for listeners. Are you building a business that can predictably produce cash flow, or are you building something that could become 10 times bigger in a few years?
Because PE and family offices can love cash flow, VC generally needs explosive growth potential. That's not a value judgment. It's just math and portfolio strategy.
Let's get into the why behind each capital source, because that's what shapes everything they do. Family offices often want long-term wealth preservation with solid returns. Private equity wants strong returns on a schedule. Venture wants outlier returns, home runs, because a lot of their bets won't work out.
Now, let's translate that into what they ask you for. Family offices may start with, how stable is this business and who's running it? They care about trust and durability. PE starts with, what's the engine of value creation? How do we grow EBITDA and what's the exit path? VC starts with, how fast can this scale? How big is the market and why do you win?
And the process differences matter a lot for an SMB operator who still has to run the business every day. Let's talk process.
Private equity tends to have the most standardized process. You'll usually see intro call, management meeting, request list for financials, a letter of intent, then due diligence, where they go deep into quality of earnings, customer concentration, legal, HR, taxes, maybe IT and cybersecurity, and then definitive agreements and closing.
And that diligence phase can feel like you suddenly took on a second full-time job.
It often does. On the plus side, PE is usually organized. If they want the deal, they can mobilize resources. On the downside, they may be less flexible if your situation doesn't fit their model.
Family offices can be the opposite. Sometimes it's refreshingly simple, a few meetings, a site visit, a straightforward diligence process. But sometimes it's slow, because there isn't a huge team and there may not be urgency.
Also, some family offices are great at closing. Others are great at talking. So owners should look for evidence. Have they done deals like yours? Can they provide references? Do they have a clear decision maker?
Venture capital process has its own rhythm. It can move fast if there's excitement. But it can also stretch out through partner meetings, follow-up questions, more meetings, term sheets, and then legal docs with investor rights that may be new to an SMB founder.
And venture often expects a certain kind of reporting cadence, board dynamics, and growth pressure. If you're used to running your business based on cash flow and customer relationships, that can feel like a cultural shock.
Let's shift to pros and cons, starting with family offices. Pro: flexibility. They may do minority investments, they might accept slower growth, they can sometimes hold longer. Pro: relationship. Some owners really like the idea of dealing with a principal rather than a committee.
Con: unpredictability. The underwriting standards can vary wildly. Another con: concentration of decision-making. If the family loses interest, changes strategy, or has a separate liquidity event, your deal can pause or die.
And after the deal closes, some family offices are hands-off, in a good way if you want autonomy. But it can also mean you don't get much strategic support when you need it.
Now, private equity. Pros: repeatable playbooks. PE can bring operational resources, recruiting help, add-on acquisition experience, pricing strategy, systems, and discipline. If you want to do M&A as a growth strategy, PE can be a very powerful partner.
Another pro is clarity. Their incentives are usually well-defined. You generally know they want growth, margin improvement, and an exit.
Cons: that same clarity comes with pressure. PE may push for aggressive targets, tighter controls, and changes that can feel abrupt. Also, you will almost certainly have more formal reporting and governance.
And deal terms can be more complex. Rollover equity, earnouts, management incentive plans, debt in the capital structure. None of that is bad by itself, but you need to understand what you're signing up for.
Now, venture capital. Pros: for the right business, venture can fuel rapid expansion. It can help you hire faster, build product, expand markets, and sometimes open doors through their networks.
And the flip side. Cons: dilution and expectations. You're selling part of the company and agreeing, implicitly or explicitly, to chase aggressive growth. If the company stalls, the experience can get painful. Down rounds, pressure to pivot, pressure to cut, pressure to sell.
Also, VC is usually not the best match for businesses where the primary value is stable cash flow rather than scalable growth. They're not being picky. They're being consistent with their model.
Okay, now let's ground this with some common SMB scenarios. Scenario 1. You're a profitable services business, say HVAC, landscaping, logistics, managed services, specialty manufacturing, and you want to buy 2 competitors over the next 3 years.
That's classic private equity territory, and also a place where some family offices can be great. PE brings an acquisition machine, lenders, diligence teams, integration templates. A family office might support it too, especially if they like the industry and you as an operator, but they may not have the same repeatable M&A infrastructure.
Scenario 2. You want partial liquidity. You've built the business for 15 years, most of your net worth is tied up in it, and you want to de-risk without fully stepping away.
Both PE and family offices do recapitalizations. The nuance is what kind of partner you want afterward. PE often wants to professionalize and scale with a future sale in mind. A family office might be open to a longer hold with less pressure.
Scenario 3. You've built something tech-enabled. Maybe it's a workflow platform for a niche industry and you've started replacing spreadsheets across thousands of potential customers.
That's where VC can make a lot of sense, especially if you can show repeatable customer acquisition, improving unit economics, and a market big enough to support a very large company. PE might still be interested later, once you're more mature and cash flowing.
Let's talk about the fit questions an owner should ask before choosing a lane. First, what are you optimizing for? Maximum price today, long-term control, speed, certainty to close, or expertise and support?
Second, how involved do you want your partner to be? Some owners want a coach. Others want a capital provider who doesn't touch the steering wheel.
Third, what is your tolerance for reporting, governance, and oversight? If monthly board decks make you want to run away, you should be honest about that now, not after the deal.
Another big one, time horizon. If you want to build and hold for 10 years, a patient family office may align better. If you're excited about scaling hard and selling in 4 to 7 years, PE aligns. If you're swinging for something massive and you can accept volatility, VC can be your lane.
Now, let's zoom in on a part that surprises owners: deal structure and control. People focus on valuation, but structure can matter just as much.
In PE, a common structure is majority control with the founder rolling some equity, meaning you sell a chunk now, keep a meaningful stake, and participate in the next exit. That second bite can be large. The firm grows the company.
Family offices might do majority or minority. Minority can sound attractive, but it can get messy if governance isn't clear. You want to talk through board seats, veto rights, distributions, major decisions, and what happens if either side wants out.
VC is typically minority at first, but with protected provisions and a path that can shift control over time through future rounds, board composition, and investor rights. You should understand that even minority investors can have significant influence.
Let's be concrete. A founder might say, "I'm not giving up control," and then sign terms that effectively limit their freedom to make big decisions without approval.
Right. Another element, debt. Many PE-backed SMB deals use leverage that can enhance returns, but also increases risk and changes cash flow priorities. Family offices may use less leverage, depending on their approach. VC usually isn't about leverage. It's about funding growth.
We should also talk about process risk. In SMB deals, the biggest risk is not just price, it's, does the deal actually close?
PE firms usually have a clearer path to close if the deal fits, but diligence is intense and can uncover issues that lead to retrades. Family offices can be more variable. Some are highly decisive. Others can stall. VC can move fast, but only if you match their thesis and there's conviction.
What about red flags? Let's give listeners some practical ones.
For any investor, watch for vague decision-making. If you can't identify who says yes, you may be stuck in limbo. Another red flag: they won't talk about their hold period, their typical deal size, or what success looks like. If they can't describe a clear pattern, you're the experiment.
Also, reference checks go both ways. Owners should ask to speak with CEOs they've backed, especially ones where things got tough. Because everyone has a great story when the numbers are up and to the right.
Let's outline a simple approach an SMB owner can take to choose between these options. Step 1. Define your goal in one sentence. For example, I want to take some money off the table and grow through acquisitions. Or, I want capital to expand into 3 new geographies. Or, I want to sell and exit clean.
Step 2. Map that goal to the investor type. Clean exit. Likely PE or strategic buyer, sometimes a family office. Growth through M&A. PE or family office with M&A appetite. Hyper-growth product. VC.
Step 3. Decide your non-negotiables. Control, culture, timeline, ability to keep key employees, location, brand, anything that matters. Put it on paper. Because in negotiations, if it's not written down, it'll move.
Step 4. Run a structured process. Even if you love the first group you meet, it helps to have options. Competitive tension isn't just about price, it's about getting better terms and higher certainty.
And step 5, build your team early. At minimum, you'll want a strong M&A attorney and a tax advisor. Depending on the deal, you may need a quality of earnings provider, and often an investment banker or broker can help you run a process, especially if you're selling controlling stake.
Before we wrap, let's answer one question we hear all the time. Which one is best?
The best is the one aligned with your business model and your personal goals. If your company is a durable cash flow machine and you want to partner, professionalize, scale, and maybe do add-ons, PE can be a strong match. If you value flexibility and patience and you find the right fit, a family office can be fantastic. If you're building something that can scale dramatically and you're ready for that intensity, VC can change your trajectory.
And there's also a sequencing element. Some businesses go from founder-owned to family office or PE, then later to a larger PE firm, and eventually to a strategic buyer. Others go VC early, then PE later when growth stabilizes and cash flow becomes the story.
So the real win is understanding the game you're playing before you pick your teammate.
If you take one thing from today, don't just ask, how much money will you give me? Ask, what will you want from this business, and from me, after you invest?
That question alone can save you months, and sometimes years, of regret.
All right, that's it for today. Next time, we can dig into what diligence actually looks like for an SMB deal, what documents get requested, what issues pop up, and how to prepare without turning your company into a paperwork factory.
Until then, keep building. And if you're considering capital or M&A, make the process work for you, not the other way around.